Hi, is this the shareholder department of Canadian Pacific? Oh, it is great. I'd like to buy 10 shares so I can start my dividend portfolio and start raking in those dividends. Wait, what, you can't? I need a what? No, I just want to buy 10 shares. I don't want a broker too. Oh, well, thanks for the help, I guess. Hello, and welcome back to the channel. If you find this video helpful, please hit the like button down below and subscribe. My name is Zachary Lindup. I'm an electrical engineer with a passion for investing, personal finance, and real estate. Dividend stocks are some of my favorite stocks to own. I like the consistent dividend payments and the consistent growth over time. First of all, what is a stock? A stock is a small piece of a company and is also referred to as an equity. Stock or equity is divided up into small parts called shares. Owning them makes you a shareholder. Shares can be owned by an individual person, an institution, or a corporation. These shares give you rights to a portion of a company's assets and profits, and this depends on how many of these shares that you own. Owning shares doesn't give you control over the corporation. For example, if you own 20% of a company's shares, it is incorrect that you also own 1/5 of that company. It is correct that you own 1/5 of that company's shares. This is known as the separation of ownership and control. Being a shareholder gives you ownership in the company, but it doesn't give you control over the company. That relies with the board of directors, the CEO, or other elected officials. The two main types of stock are common and preferred. Common shares give you voting rights and entitle you to a portion of the company's profits. Preferred shares do not give you voting rights, but you are first up if the company goes bankrupt or needs to sell off shares fast. By owning shares, you as a shareholder can either make income through capital appreciation, that is the stock price going up over time, or dividend payments, or some combination of both. So what are dividend stocks? There are several ways that a company can pay out their earnings. Some companies invest their earnings directly back into the business through process improvements, more inventory, or share buyback programs. Other companies don't have the ability to retain large sums of capital, so instead they pay out their earnings in the form of a dividend. A good example of this is a consulting firm. Once a consulting firm is done paying out all its employees, its expenses, and other liabilities, there may be a large chunk of money left over at the end. That money could be used to open a new branch, but this may not be beneficial to do at the time. If the money can't be used effectively to grow the business, then it can be paid out to shareholders in the form of a dividend. The dividend payment is determined by the board of directors. This is usually paid out quarterly, so once every 3 months, you will get a dividend payment, but this can also be paid out semi-annually, which is twice a year, annually, once a year, or even monthly. It all depends on the company and their payment scheme. The dividend is shown as a dollar amount per share on the company statements. These financial statements are available under the shareholder section of most company websites. Sometimes if a company does really well in a specific quarter, they will pay out a special dividend. And this dividend could be much higher than the normal dividend that it pays out. Costco does this quite often. Usually when you search a dividend stock online, the dividend will be shown as a percentage yield. This is the dollar amount of the dividend divided by the current stock price. So as the stock goes up, the dividend yield will go down. And if the stock goes down in price, the dividend yield will go up. A good dividend stock will have solid financials, will have a share price that slowly goes up over time, and a dividend that is raised every year. If you can find good opportunities to buy dividend stocks when the share price is down and the yield is up, then these are good opportunities for you to buy. Now that you know what a dividend stock is, you might be asking yourself, where can I buy a stock? Stocks are purchased and sold on something called an exchange. In the US, the common exchanges are the NASDAQ and the New York Stock Exchange. In Canada, the Toronto Stock Exchange is the most common. There are other exchanges as well, smaller ones such as OTC, which is over the counter. Now that you know what an exchange is, it's time to actually go and buy a stock. There are several ways that you could buy a stock. One way is to get a friend or someone you find to transfer a share of a company over to you through a direct registration program or a direct stock purchase plan. They do this by filling out a bunch of paperwork, essentially transferring over a share that they own under your name. And then once you have that share certificate through either a direct registration or a stock purchase plan, you can then buy additional shares through a transfer agent such as Computershare. When I bought my first stocks, I thought this was the way you had to do it. So I found a forum online because I didn't know anybody that owned any shares. I got somebody that I found on there to transfer me over some shares. I sent them the money for the shares through e-transfer. They filled out all the paperwork, and then 3 to 6 weeks later, my stock certificate showed up in the mail. There's a much easier way to do it though. This is through something called a broker. A broker acts as the middleman between you as the buyer and an exchange. In return for this service, they either get a small fee or a commission, which is paid by you when you go and buy a stock, or the exchange itself pays them. Some examples of online brokers are Robinhood or Public.com in the States and Wealthsimple in Canada. Most big banks also have some type of brokerage account. For us in Canada, that's TD Ameritrade, Scotiabank iTrade. Generally, the fees associated with these accounts are slightly larger though, and I would recommend one of the aforementioned online brokers if you're starting out. Most of these platforms are really simple to use and straightforward, and they all provide pretty good customer service if you have any questions or concerns. Now that you know how to buy a stock, the next step is to calculate how much you want to make yearly in dividends, whether this is to retire early or to save up for many years down the line to retire. To do this, I would calculate my monthly expenses, add a safety cushion to that, and then multiply by 12. Once you have that number, for example, let's say it's $50,000 for the year, you can multiply that number by 22 or 28, or somewhere in between. This gives you between a 4.5 and a 3.5% yield, which is pretty achievable with safe dividend stocks. Dividends are also fairly tax advantaged. There is also a dividend tax credit depending on your amount of income, so check with your tax agency. Another important factor is diversification. Generally, it's accepted that if you own between 25 and 30 stocks spread evenly across the different sectors, this will be your most cost-effective approach to investing and provide the safest overall returns with the lowest risk. There is some risk involved with investing, so do your own research on the companies that you're planning to buy and make sure you're buying companies with solid underlying fundamentals. By diversifying across sectors and across companies, that gives you a fairly safe safety net, just in case one sector or one company is doing poorly that month. Your overall return across your portfolio will still be fairly steady to meet your goals. Some sector examples are financials, such as JP Morgan and Chase and TD Bank, or communication services, such as Bell or Verizon. For a complete list of sectors, see the link below in the description. Now that you know what a stock is and where to buy a stock, you might be asking me, but what stock should I buy? A good place to start with this is the Dividend Aristocrat list. Dividend Aristocrats are a good place to start. These are companies that trade on the New York Stock Exchange and make up a portion of the S&P 500. They are also companies that have raised their dividend over the last 25 years. Some investors use other criteria as well, such as a minimum market cap of $3 billion, certain PE ratios, certain income to expense ratios, etc. There are also something called Dividend Kings. Dividend Kings are any company that has raised their dividend every year for the past 50 years. These do not have to be listed as part of the S&P 500 index. They can be any company whatsoever. They can be mid-cap, large cap, small cap, it doesn't matter. Just as long as they've raised their dividends for the last 50 years. For this reason, Dividend Kings might not be the safest investment that you can buy. Dividend Aristocrats tend to be large cap companies, hence being on the S&P 500. These no longer experience huge growth, but are generally considered recession-proof with steady profits and dividend growth in both bad markets and good markets. Remember, they need to have raised their dividend every year for the last 25 years. That puts them through some of the toughest times, the dot-com bubble, the 2008 financial crisis, the COVID pandemic, etc. Some Dividend Aristocrat examples are Walgreens, 3M Co., Realty Income Corp., Amcor PLC, and Federal Realty Investment Trust. For a complete list, see the link in the description below. Another form of income can be loaning out your stocks. So once you have a solid portfolio of dividend stocks, you can loan those out to a borrower. The borrower transfers cash plus a lending fee in exchange for borrowing your stocks. This way you can make some additional income on top of the dividend payments and the capital appreciation that you're experiencing for owning those companies. There are risks associated with this strategy though. The main risks are if the borrower becomes insolvent or if the value of the cash that he lent you drops in price. The difference between these two is the worst case scenario that the lender would experience and would have to pay the difference. So that's dividend investing in a nutshell. Please like and subscribe if you found this video helpful. For more information on the terms covered in this video, I've linked Investopedia below. They can be a great resource to help you on your investment journey. Thank you for watching. Have a good day.